Well, I've never been a DJ and I've definitely never been a genie, but today in this video, I'm going to fulfill a request by a newsletter reader, Ron. And if you aren't signed up for the newsletter, just go to DapperDividends.com or click the link below and you can get the free and fantabulous weekly newsletter. But because Ron said he's too cheap to subscribe to Simply Safe Dividends, he wanted me to look up for him all the 99 very safe, which is the highest safety score that Simply Safe Dividends gives a stock. Now, it doesn't mean that a dividend cut can't happen, but it means that as of this recording right now, it is highly unlikely that these companies will cut their dividend, but they also give a valuation rating. So these stocks look like they're undervalued. And as Ron said, he wanted to know the ones that also had a perfect, well, near perfect safety score of 99 very safe. We're going to do this reveal style one by one. Pause the video if you want to look at any of these numbers. We're not going to go in depth on all of them because we'd be here all day. But if you want to go further in depth, simplysafedividends.com offers a free 2-week trial with just an email address. You don't even need to put your credit card in. So you too can look at all the undervalued and 99 very safe dividend stocks. So when I did this screen, I searched for very safe rated stocks. Now they go from 80 to 99, which is the very safe bucket. So there was about 59 of them that came up, and 12 of them, well, 11 technically, were considered very safe at 99, but there was a lot more that we'll go through really quick. I'll scroll through, pick out a few names, and if you want to look at any of what's on the screen a little more in depth, just pause the video. So the first one on our list is A.O. Smith, ticker AOS, and they manufacture and sell water heaters, boilers, and water treatment systems. Basically, they're the company that makes the tank that heats your hot water. Hey, we all love hot water, so 99 very safe, looking like it's undervalued by a few bucks here, $64, expected range of 70 to 86. And the way that Simply Safe gets these numbers is they will either take the price to earnings ratio or the dividend yield and take that on a 5-year average and then give a range of 10% above and 10% below that 5-year average, and that's how they figure out and give something a undervalued, overvalued, reasonably valued rating. And as you'll see on the columns that I put in, you'll get your dividend yield, the dividend growth that was last, the 5-year dividend growth CAGR, the 10-year dividend growth CAGR, their dividend growth streak, which A.O. Smith has 32 years. This is the earnings payout ratio. Kevin Burgess is particular to the earnings payout ratio. I like free cash flow payout ratio, but both of them can be a little bit manipulated. I've got their net debt to capital on there, the return on invested capital, the higher the better, and the credit rating. Some of them don't have a credit rating because maybe they didn't apply for it. They don't need to borrow money because they don't have a lot of debt. Like A.O. Smith has 5% net debt to capital, so they don't really depend on that credit rating. So moving along, next we've got Elevance Health, ticker ELV, where they collect monthly premiums from people and companies for health insurance. Then they use that money to pay for its members' medical bills when they get sick or need health care. As of this recording, $393 share price, and they looking like they could be about $100 undervalued. Obviously, a lot of issues going on with these managed healthcare companies, but historically, they've had a very fast dividend growth CAGR, and they have no net debt. Next is West Pharmaceutical Services, ticker WST. Now, they manufacture the rubber stoppers, plastic containers, and injection devices that pharmaceutical companies need to safely package and deliver their medicines and vaccines. Current price of $224, an expected price range of $265 to $323, but a 0.37% dividend yield and only average dividend growth. Then we've got H2O America, ticker H2O, and they deliver clean water and provide wastewater services to over 1.6 million people across 4 states, charging customers monthly for that utility service. Current share price of $51, expected $69, and they have a little bit higher yield than what we've seen so far, 3.27% average dividend growth, but they've been growing that dividend for 50 57 years. Next, we've got Novo Nordisk, ticker NVO. I'm sure you've heard of them. They develop and sell prescription medications, especially diabetes drugs like insulin and those weight loss drugs, the GLP-1s that everyone's talking about, like Wegovy, to patients and healthcare systems worldwide. And Novo has a share price of $74, expected to be maybe $113 to $138. Very fast dividend growth. That last dividend raise was 22%, super fast, and they've been growing that dividend for 28 years with a very strong AA credit rating. Number 6, MSA Safety Incorporated, ticker MSA. They manufacture and sell safety equipment like gas detectors, breathing apparatus, is it apparati, and protective helmets to workers in industries like firefighting, construction, and oil and gas. They might be undervalued by about $10. Very slow dividend growth. They've been growing that dividend for 58 years. 1.28% dividend yield currently. And that's something you got to watch with some of these companies that are dividend kings, is that they'll raise that dividend very slow, token dividend raises, just to keep that crown going. Could be better, but at least you know what you're getting into before you buy it. Number 7, you know them, you love them. They're a dividend king, Johnson & Johnson, ticker JNJ. They develop and sell those prescription medicines and medical devices, with most of their $89 billion in annual revenue coming from drugs that treat cancer, immune diseases, and other serious health conditions. Now, their dividend yield is way above that 5-year average, and they're at $155 a share, but they could be expected to go to $169 to $207. Again, they've been growing that dividend for 62 straight years, and they have very low net debt to capital of 15%, which that means that in the capital structure, 15% is debt, while 85% is equity. And they are one of a few companies, I believe, them and Microsoft, to have a higher credit rating than the United States government, AAA, very strong. You've seen a trend here, got a lot of healthcare sector companies going on. Number 8, Humana, ticker HUM. They sell health insurance plans, especially Medicare Advantage plans for seniors, where they collect monthly premiums from members, and the government pays them to manage healthcare benefits for nearly 6 million Medicare members. So this is another one kind of in that same vein as United Health. A lot of concerns around this space, a lot of headwinds, but they have a current share price of $230, and they expect could be going to $456 to $557. If that happens, you'll have to wait and see. But the dividend yield of 1.53% is way above the 5-year average, and they have had no dividend growth according to Simply Safe since 2023. But chances are they're not going to cut it. So if you're a dividend growth investor, they have a 12.3% 10-year dividend growth CAGR, but as of late, it's frozen. Out of the healthcare, into the autos with GNTX Corp, ticker GNTX. They manufacture and they sell auto-dimming rearview mirrors and other electronic safety features to car companies, with about 98% of their revenue coming from supplying these high-tech mirrors and camera systems to automakers. A little bit undervalued, $21 share price, expected $27 to $33. I believe they're Canadian, and they too have had a frozen dividend since 2020. But Ron, you asked, you're receiving, and just like Humana, they have no net debt. Now, this company's in my wheelhouse, Expeditors International, ticker EXPD. Used to work at one of their big facilities in Bensenville, Illinois. Shout out. They help companies ship products worldwide. They arrange air and ocean transportation. They handle customs paperwork, and they manage supply chains. And did you know they charge fees for these logistics services without owning any planes, ships, or trucks themselves? $112 share price, expected $117 to $143, 1.37% yield, 30-year dividend growth streak. They have no net debt, and their 10-year CAGR is 8.6, almost 9%. Number 11, California Water Service Group, ticker CWT. They provide clean drinking water and wastewater services just like H2O does to over 2 million people across California, Hawaii, New Mexico, Texas, and Washington, who they also send monthly bills to. CWT, $45 current share price, could be to $59 and $72 expected, 2.63% yield. They've been growing it for 57 years, and their dividend CAGRs in the 5% to 7% range on average. And then we get to number 12, which is a double up. It's Brown-Forman, ticker BF.A and BF.B. And if you didn't know, they're in a bit of a pickle because they manufacture and sell alcoholic beverages like Jack Daniel's whiskey, Woodford Reserve bourbon, among other premium spirits, and wines to distributors, retailers, and consumers all around the world. Now check it out. There's the BF.A and the BF.B. So there's the Class A shares, which is the BF.A, which they come with full voting rights, but the Brown family owns about 70% of the shares outstanding of the A class, so they're going to get to control all the voting decisions that go on with the business, so just be aware of that. But the B shares, which is BF.B, they have no voting rights, but they are more liquid, so a lot of institutions and retail investors, traders, like the B shares because they can sell and trade them a lot easier because 70% of the A shares are held by by the Brown family, and they're not going to be selling most likely. It seems a lot of younger people aren't drinking, probably a good thing, which is also why Diageo has been way beaten down, but $28 a share, and they expect the A shares to be somewhere around 67 and the B's to be around 55. But other than that, the dividend is the same and the economic ownership in the company is the same. They've been growing that dividend for 40 years, so they're close to being a dividend king, but it looks like they have slowed down that dividend growth to just a little bit below what they average for their 5 and 10-year CAGRs of 5.5% and 7%. All right, buckle up, you get a bonus. We're going to go through all the rest of the companies. This is going to be super quick. I'm going to pause at a few notable names that I know. So if anything jumps out at you, just pause the video and you can get a little bit more of an insight. Starting with Feely, just because I like that name, Franklin Electric Company. They are undervalued. Yahader Up North, ticker CNI, Canadian National Railway. Eli Lilly, everybody knows and loves, so they're also potentially undervalued along with Novo Nordisk. Good old PepsiCo, around $130 a share. Who would have thunk it? They could be potentially very undervalued. Almost a 5% dividend yield for PepsiCo. You have the two Nestle's here, ticker NSRGF and NSRGY. Merck jumps out at me. Put them on your watch list because, kind of like Warren Buffett said, it's really hard to tell the pipeline for a lot of these pharmaceutical companies. So the best thing to do is when you see the big names like J&J, like Merck. I see J&J Snack Foods down there, different J&J, but also on our list. I think they own Icy brand and Dippin' Dots. But Merck, what you want to do is just buy them when they're undervalued and then hold. Now we got that J&J Snack Foods, ticker JJSF, Hormel Foods, General Mills. There you go. You got some consumer packaged food and meat companies. A lot of you love NextEra Energy, ticker NEE, looking way undervalued. There you go, another distiller. We love Guinness. We do our part to try and support Diageo by buying Guinness, but it's not been enough. We have to do more of our part. Looking way undervalued, almost to $100 a share for Diageo. Chevron and Nvidia. That's an interesting one there that we've got Nvidia as undervalued. 141, they're expecting $184 per share. Yeah, 0.03% dividend yield. I don't even know why they fired around paying that dividend, but there you go. Simply Safe thinks that Nvidia is undervalued. Those of you that are Cubs fans or remember back in the 80s that they used to have the big Toro sign at the friendly confines. Toro, they do, agricultural and farm machinery, anything that has to do with cutting your grass, maintaining that landscaping. Toro. Heard my guys on the Dividend Talk podcast bring up ASML. Why? They're kind of like the manufacturer, right, of the picks and shovels for the AI, the semiconductor industry. They have the machines that make the chips that everybody needs. So that's another interesting one, ASML. And then we've covered Rexford Industrial Realty on the show. I know they've gotten some love from other channels, but ticker REXR is a REIT, and they do California industrial properties, the kind of things that I'm around every day. Let me know in the comments below what you thought of this, if you found this helpful, if you'd like to see something like this, maybe every quarter or so. If you want to see what I'm buying, if anything, on a daily basis, follow me on Blossom. It's got a beach you can dance to. It's from Canada, and it's expanding, and it's a fun environment of investors just talking about investing and finance. And then just because I like you, dear dividend investing viewer, in this floating little box next to my head, I used 4 AI chatbots to look up and have them search for quality, cheap, undervalued dividend growth stocks. It was interesting to say the least, but I think we got one you might want to put on your radar. So click that floating little box and I'll tell you which one it is there.